This is InvestTalk, independent thinking, shared success.
I went through the last 6 months of podcasts and haven't heard anything about Old Republic International, ticker ORI. I have a small position in the company. What are your thoughts on Old Republic being a cornerstone in my portfolio long term as one of the buy it and forget it stocks? Thank you for all your time and helping me learn and grow as an informed investor. I look forward to hearing your answer on the podcast.
All right, looking at Old Republic, and as you would imagine, this is a name that's been around a long time. It's also a pretty boring name for most people. It's insurance. It's an insurance business. It writes property and casualty insurance, and it's a name that we actually own for clients. So we like the name. We like the company. It's not exciting. It has a market cap of about $9.5 billion, so it's a mid-cap name. It's been around. Let's see. I'm zooming all the way back on a chart. It went IPO all the way back in 1972. 1972. That's how long this has been around. Split adjusted, it was at it IPO'd around $1. Let's see. Yeah, about $1.15. Split adjusted, now we're at 38 cents. Sorry, $38.57. And it has a 3% dividend yield. So it's had good, nice, solid performance over the years. And if you look at profitability, return on equity is around 13%. That's pretty good for a mid-size insurance company. And they have minimal debt on their balance sheet, good cash flow, about $1.3 billion on an $8.5 billion enterprise value. That's solid. So, one worry, and this is something we're looking into, would be tariffs, right? Where if you're a property and casualty insurer, you have to pay out claims that replaces property, whether that's a home or whether that is somebody's car, whether that is somebody's material, stuff that was stolen, right? So when you have tariffs, the cost of goods generally are going up. It's going to cost more to replace that. So that's one worry that we're having. But in general, that is more of a near term type of problem. The whole industry will have to deal with it. They'll have to adjust prices, etc. So it's not something I think long term is a problem, but I would be concerned that level, in the short term at least, it could weigh on the share price. But if you're talking about a set it and forget it type of company, this is that type of company. Very well run, boring, but growing its earnings consistently over time and allocating capital and that cash flow effectively. And most of that cash flow is going towards buying back shares, which we like. In 2022, they had 308 million shares outstanding just 3 years ago. Now it's at 247 million shares outstanding. So they bought back about 20% of their float over the past 3 years. That's pretty strong. It's a pretty strong shareholder yield. That's on top of the dividend, 3% dividend that you're getting. So big fan of Old Republic, but understand near term, there could be a bit of headwinds with the tariffs. Let's go talk to James in New York looking at ASPI. Do you own it or looking to buy it?
I own this, and I own it on no fundamental basis. Company doesn't have earnings, but looks like they're in the pre-development of something called HALEU, which I believe is supposed to be useful in the production of uranium. But they did get some catalyst, some news that it's receiving funding from a company called TerraPower, which I believe is a Bill Gates affiliated company. But do you think, as a high-risk play, this might be a good opportunity to take a spin on something like this if it's purely speculative?
Well, it's definitely speculative. They have very little revenue, only $1.2 million last quarter. and it's a $542 million market cap, and they're losing money this year. They are expected to make money next year, 5 cents a share on a $7.52 stock. So, it's still expensive, but the trends are positive. It's in an uptrend, and it's going to be wildly volatile. You've seen it go in October. It was trading around $3, went all the way up to $9 and change. In November, fell back all the way to a low recently. Let's see, this was in March of $3.70, and now it's doubled from there to $7.52 now. So that's the type of volatility that you are going to get with this name. And you need to be prepared for that. Now, would I rather buy when there's a bit of volatility to the downside to get more shares? Sure. I would rather, play the buy the dip in this name until that uptrend breaks. Obviously, right now it's surging a bit, but this could easily break out to $10 and you miss it. I don't know. But it's certainly high risk. I like the space that it's in. Obviously, I'm a big fan of uranium and the push towards that and being a source of baseload power. Now, how do you get there? How do you deploy these facilities effectively, safely, efficiently, cost effectively? All of that is still up in the air in many ways. So if you have faith in their technology and their ability to help execute on that mission over the medium to long term, then I have no problem with this as a small position in your portfolio.
All right, thank you.
No problem. Thanks for the call. Now let's go answer another YouTube question. As I think we also post our podcast in video form over on our YouTube channel. So we get questions in the comment section there. So let's grab one now. Ugar says, hi, I'm thinking of adding this stock to my Roth IRA. Can I have your thoughts? O is the symbol. And this is Realty Income. This is one of, I believe it is, the largest retail REIT, public retail REIT. About a $51 billion market cap. It has consistently increased its funds from operation, which is effectively the earnings for a REIT, pretty much every year. Even in 2020, it increased its funds from operation by 2% in the midst of the pandemic. So that was pretty impressive. Sales are growing dramatically. They were at least, but they have slowed down. They were growing about 30% about a year ago, now only about 10%. So, and this year expected to have sales growth in the mid-single digits. So not a fast grower anymore. Earnings are expected to continue to do well, 5.7% dividend yield. And if I let's take a look at its profitability. Return on equity is sitting at about 2.5%. That is pretty low, but historically, the return on equity is much higher. So I would want to see this rebound a bit more. Before 2019, it was at 5%. So it was just doing much better. Let me look at the debt profile. Yeah, it does have a good amount of debt. Its cash dividend pay ratio is fine, 77%. So it certainly could pay out this dividend. I have no issue with it. Over the long term, it goes up. It has strong diversity, right? Thousands and thousands of properties, and pays a nice dividend. So I'm inclined to like this name over the long term. So that was Realty Income. Oh, now let's touch a bit on what do I get to? Let's get to how warfare is shaping the demand for certain metals. And this is coming from Robert Friedland. He is in the metal space, understands the demands of government and modern warfare. And what he's seeing is rising defense spending in military conflicts. Think Ukraine, think Kashmir, really around the world. Is really exposing a shortage of certain metals. Copper is the big one because it goes into ammunition, but it goes into electricity. And there's a lot of overlap here with the demand for metals for warfare, as well as demand for metals in the green energy space. So copper, like I said, important for ammunition. Same with zinc. And then niche materials, graphite, for example, germanium, these are used in weapon systems. And in the American government, high up, many are concerned about the supply chains of critical raw materials. Many are saying, Carnegie Endowment, said that in February, they found mineral inventories for the U.S. National Defense stockpile has dwindled since the 1950s. Remember, post-World War II, right? We're still kind of geared up for who knows what was going to happen after that. And what they said was that it covers less than half the military demand in a hypothetical 1-year conflict. So that's probably going to need to be stockpiled throughout the coming years. And China's dominance in raw critical minerals is a threat, not just to industry, but also to America's military dominance. Now, President Trump has issued several executive orders on minerals since he took office in January. And one is on to boost domestic mining, others deep sea extraction. So clearly it's on the radar. Doesn't seem to be at the top of the food chain within the Trump administration, but it's certainly on their radar. And the military industrial complex, shall we say, tends to be pretty bipartisan, right? They support both sides. And so I think this is a true issue and tells me that on the investment side, it is important to have exposure to the metals that are needed for military, as well as aerospace, for fighter jets, semiconductors. So some minerals there would be scandium for aerospace, beryllium, Brylllium. It's for fighter jets. And then semiconductors contain gallium. And so, these are all minerals that not talked about much, but finding ways to get exposure, I think, will be important throughout the coming years. And there are big companies going after this. BHP, Glencore, Barrick Mining. They're all looking to mainly buy copper mines, but all these other type of minerals that are needed as well. Project Blue estimates that copper demand will boost from higher military spending is about 500,000 tons per year, or about 1.5% of annual demand. And so it's not just the green energy space anymore. It's also the military space that's demanding these critical minerals. And copper is probably top of the list, but there are many others as well. Now let's keep things going and play another fresh question from 888-99-CHART.
Hi, this is Gwen from the East Coast. Thank you for all that you do and the great information that you provide. I have 2 questions. The first is, what are your thoughts on the institutionalization and regulation of the crypto market that has occurred thus far? And the second is, do you consider IBIT, the BlackRock crypto ETF, a viable investment vehicle to get crypto exposure? Thank you again for all that you do, and I'll listen to the podcast for the answer. Bye.
Well, let's separate crypto and Bitcoin. Even though Bitcoin is a cryptocurrency, it's cleaner. Let's just say that. And IBIT, that's what you're investing in. You're investing in Bitcoin. You're not investing in the cryptocurrency industry. There are a lot of people within the industry that are Bitcoin maximalists. They just think that's all we need. The rest is just a sideshow, and in many instances creates a bad rap for the space. And I tend to lean in that direction. Let's just say that. Now, I think there are applications for crypto, for decentralization, for tokenization that will gain traction over the coming decades. But I also think there are a lot of frauds. There are a lot of just people that are in it to take control of something they can't control in what they call the TradFi industry, right? The traditional finance. And there are just a lot of bad actors that are seeing crypto as a way to do whatever they want, make up the rules, right? That's what you can do when you create a coin. You can make up the rules, and anybody can go buy it. So if you have a good marketing system behind it, you can get anyone to buy it, and it's anonymous, right? So it becomes a, for all the people, all the haters, it is a place that laws are broken under the cover of cryptocurrency, and money is moved to bad actors, and there are a lot of problems within the space. Now, will regulation solve that? It's up to the regulators. How are they good actors? Are they acting in good faith for the consumer? Or are they in it for the donors that are funding the campaigns, for example? Or those within the parties, within government, utilizing it for their own gain, right? And making sure that the laws that are put in place still allow them to function and keep the grift going, right? And I think that's the big worry of quote unquote regulation, is regulation's only as good as the regulators that are doing it, right? And how many conflicts of interest they have, how much power they have to really protect the consumer and do the things that will legitimize the cryptocurrency space. And I think if there is that, then it can continue to grow. But the more that there are scams, you have certain, FTX, right, collapsing. It's not good for the space. It's not good for the reputation. And if you continue to have those because of poor regulation, then I think it's going to continue to struggle. And it's going to be, regardless, it's going to be very tied to liquidity dynamics in the market. You see that, right? 2022, what happened? NASDAQ was down 33%. What happened to Bitcoin? It went down considerably. Zoom out here. It peaked in late 2021 at, 67,000 and fell all the way to 17,000. Now we're back up to 105 and change. It could easily go back down to 30, 40, 50,000. I see no reason why that can't happen. So understand that it's going to be very volatile. Understand that regulation probably won't solve everything. And Bitcoin is very different than these altcoins and other aspects of cryptocurrency. Now, I hope you've been telling your friends and family that our audio podcasts are available in video form over on our YouTube channel. So let's go answer one of those questions from there now. Jim Lay says, what do you think of ALG stock? Is it a good long-term hold? ALG is the symbol, and we're looking at Alamo Group. All right. So let me pull this up here. ALG. Now, ALG, small cap name, about $2.5 billion market cap. They manufacture equipment for right-of-way maintenance, agricultural, industrial, and government and commercial markets. I generally like this. It tends to be in the ag space. Let me pull that up on a different. Usually, I like to see the breakdown of their revenue between different. Okay, so 48% is machinery manufacturing in the ag space, basically agricultural and farming. 51% is conventional vehicle manufacturing. Okay, interesting. So kind of split 50-50 there. You have earnings expected to go up this year 3% after being down 12% last year, then up 11% next year. The trend in earnings are positive, although last quarter revenues fell 8%, earnings fell 2%. Longer term, it does have a pretty good growth trajectory, just consistently earning more and more money. $200 million in free cash flow. I like that. About 11, 12% free cash flow. Return on equity. I like that. That's solid. I don't like that it's continuing to issue more shares. It's not taking that cash flow to buy back shares. I would like to see that a bit more. The chart is okay. it's rallied. It's up on the year, unlike a lot of things. And so technicals are now turned from neutral to slightly bullish. And I like the ag space, so it's tough to find good exposure there. So I'm going to give Alamo a thumbs up because I like the balance sheet, very little debt, and I like the space that it's in.
Hey folks, this is Matthew calling from Kentucky. I love your show, appreciate all the advice. Ticker symbol that I'm looking at is Boeing BA. It's something that I've been invested in for quite some time. Just wanted to hear your advice on that as far as holding my position.
All right, looking at Boeing, and if you've paid attention to markets for any length of time, you know that Boeing's had some problems, both with safety, with their workers, with leadership, allocation of capital, just across the board. It's just been a disaster for the last about decade or so, maybe a little less, but call it decade, because these things build. And I said this a while ago, a few years ago, that until Boeing cleans house on its management team, I just don't find it investable. I think management is so important, especially for these companies that are big and diverse and have a very has a very complex product to produce. And they were in a position of dominance. And when companies become too dominant, they slack off. They allow that dominance to create overconfidence in their product, and they turn to financial engineering. That's what happened with Boeing. For a while, they were just sitting there because they could borrow money. They borrowed money and they bought back stock. And their debt levels ballooned. And then you had COVID. Okay, and suddenly they had demand fall off a cliff. And, back in 2018, they only had $12 billion in debt. And by June of 2020, they had $60 billion. And, that rise in debt wasn't just because of COVID. Okay, if you look at March of 2020, it was at $38 billion. So it was already skyrocketing pre-COVID. And that was mainly because the disaster, the safety issues with the Dreamliner. And, they used that cash flow to buy back stock. And they didn't focus on their core product. And this is all about poor leadership. And that leadership is still there. So while we had deals with, UAE going to buy some Boeing planes, I don't think it solves their core problem. Bad leadership, and now a worry about safety of their products, which is the bread and butter of any airline company. It should be safety. And they let that get away from them. And so until there's leadership that can come in and reinstill a culture of safety, I just don't think it's investable. So I wouldn't own it. Thanks for the call. Now, lastly, I want to touch on a potential rule that could be implemented sometime, I think, in the Trump administration. And it's about what's called the supplementary leverage ratio. What this does is will allow banks to hold low-risk assets, such as U.S. Treasuries, on their balance sheet, and it's not a hit to their leverage. Basically, banks in a fractional reserve banking system, banks have leverage. Typically, it's 10 to 1. Commercial banks can lend leverage up to 10 to 1. So they have $1 billion in assets, they can make $10 billion in loans. Okay. Now, owning a treasury effectively is loaning money out, right, to the U.S. government. And this would say that doesn't count. Those assets, lending to the U.S. government, doesn't count towards that 10 billion. So it allows those banks to lend more. And I think this is the number one biggest lever that any administration has to pull, which is to allow these banks to buy basically an unlimited amount of treasuries, which allows the government to borrow infinitely and to keep the treasury market functioning. But it would be highly, highly inflationary, but it would also be bullish for equities. So it's something I'll be watching to see if this gets implemented. And if it does, you have to take it as bullish for markets. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes. And if today's show made you think about your own financial picture, your investments, taxes, retirement, and whether it's really working together, let's talk about it. At KPP Financial, we offer a no-cost portfolio review to help you bring clarity and confidence to your financial picture. And we practice parallel investing, which means we invest right alongside our clients. So just go to investtalk.com and click on the portfolio review button. Independent thinking, shared success. It's InvestTalk. Good night.